Tom Bowley, Chief Market Strategist here at EarningsBeats. Hey, good morning, everybody, and welcome to this Tuesday, November 26th, 2024 edition of Trading Places Live at EarningsBeats.com. I'm Tom Bowley, Chief Market Strategist here at EarningsBeats, and it's a pleasure to be with all of you this morning. We've got a great show again lined up today. Really, I mean, the market's been awesome. Can't really complain. We're in that most bullish period of the year time frame. Market continues just to kind of move up. We did have some selling yesterday after some early morning strength, and that could lead to a little bit of selling today. I don't know how long it lasts again because we are in this really bullish period. Usually selling doesn't stick very long. Doesn't mean we can't go down just because it's a historical bullish period. I always say that for me, history is nothing more than just a secondary indicator. I don't buy and sell based on what history has told me has happened in the past, but it is a nice confirmation. If you're already bullish or bearish in the market and history lines up with that, belief, then I think it does add something, maybe adds a little confidence to your trade. But we're in the midst right now. We just started it. But we're in the midst right now on the S&P 500 of one of the longest stretches throughout the year where we tend to see this bullish action. In fact, we're in the midst right now of a period in the S&P 500 where we've gone up the average annualized return of 18 consecutive days. 17 of those days are higher. Only one is lower. And so a lot of times in the market, especially during periods where history is kind of trendless, you'll see a lot of up days followed by down days, back to up days, down days. But it's very unusual. In fact, this is the only period of the year where you have 18 days in a row where only one of those 18 days is bearish or has a negative annualized return. So again, what that tells me is that the odds are that the market is going higher based on history, but it's not a guarantee, never a guarantee. But if you look at the action that we've seen over the past few days, it seems like the market just keeps going up, especially the small caps. Small caps really like this time of the year as well. And we've got a lot of fundamentals that we've talked about that I think lead to expectations of outperformance by the small and mid caps. At least I'm expecting outperformance. And so I think you put all that together and, it's hard. It's almost impossible for me to have a bearish mindset this time of the year unless the market is really breaking down. And we haven't seen anything like that. So I'm continuing to keep bullish mindset here as we go throughout, the balance of 2024 and into, and into 2025. And so that's how I'm approaching my trading. Anytime we're in a secular bull market, we're advancing in a secular bull market. I don't think bearish thoughts. I mean, there might be a stock here or there that you might think, okay, had a big gap down, it's come back up near resistance, something like that, and it might roll over. But for me, if 70 or 75% of the stocks are going higher, why would I want to spend my time trying to find the 20 or 25% that are going to go lower? It just doesn't seem to make a whole lot of sense. So I like to trade with the flow, with the momentum, especially in a secular bull market advance. And when you get into these advances like we're seeing, these tend to be where you make the most money. The market doesn't go up every single day for 6 months at a time. It usually goes up in spurts, and then it'll rest for a while, maybe even tease you a little bit to the downside, and then it'll go off into another spurt to the upside again. That's the history of the market. That's the way it usually works. So I think being more on the bullish side makes sense because a lot of times you don't know exactly when these bullish advances are going to occur. You don't know how long they're going to last. And so part of, the most difficult part to me in the stock market is after the market's made a 2 or 3 week advance. And then I get a question, what should I do now? Should I get in? And after the market's really overbought, I mean, that becomes a much more difficult situation and position to, mostly because of the risk you have to take. It's not that I don't think the market goes higher, but you got to think about what your risk is. And after you've gone up for a week, 2, 3 weeks, you get pulled way away from, say, the rising 20-day moving average. And so just a normal 20-day test sometimes can set up to, to be a 5 or 6% loss. And so you have to understand that there's additional risk in the market when it's overbought. Doesn't mean you can't invest, it just means that there's more risk and you have to accept that risk if you're getting in from a short-term perspective. Anyhow, yeah, I mean, I see the market really strong. I don't see anything that's changed. I do. Yesterday on the IWM, we saw some selling in the afternoon and we kind of printed a little bit of a shooting star candle with a negative divergence present on the daily chart. So we're going to look at that in just a second. But other than that, no, I mean, I think we're in pretty good shape. Anyway, let's go ahead and take a look at what happened yesterday. So I'm going to start off. Let me see if I can, there we go, zero in a little bit for you. So yesterday, the Dow Jones Industrial Average up 440 points, 1%. To the 44,736.57 level, getting close to 45,000. This would be the first time we've tested 45,000. We didn't quite get there yesterday. I think we were at 44.8 and change. But this would be the first test, and that's a psychological level. Every time you hit these 1,000 increments. With the Dow, maybe it's not as big a deal anymore because we've gone through 44 of these 1,000-point increments. But the S&P 500 now has been over 6,000 a couple times. Yesterday was clearly over, came back down, closed below that level. So 6,000 is a big level psychologically. I think the high we had was 6,001, but we need to break through that level. Obviously, that would, I think, encourage more buyers out there. The NASDAQ up 51 yesterday. That was up a little more than 0.25%. But if you look at the NASDAQ 100 down here, you can see that, and of course, that's going to be the larger cap, the more the Mag 7 type stocks. They were only up 0.14%. So lagging the NASDAQ as a whole. So it just shows you, and I think if you look at the performance of many of the Mag 7 stocks over the course of the last couple months, it's a completely different look than what we've been seeing with the small caps. And I think that's catching a lot of folks by surprise. And now I'm hearing folks saying, well, the market can't go up if Mag 7 don't go up, because the Mag 7 are the most highly or heavily weighted stocks on our major indices. And that is true. But I think it's providing an opportunity into a lot of areas of the market that maybe don't get recognized as part of the S&P. I mean, we're talking about the small cap 600 here, the S&P 600 small cap. I usually follow the Russell 2000. Which the ETF that tracks that is the IWM. So normally the IWM is something that I focus on quite a bit. But I think with small banks getting some relief now from the Federal Reserve cutting Fed funds rates, I think that widening spread for small cap banks, mid cap banks, I think that's going to open up the doors to lend more. And as a result, small cap companies, mid cap companies have more access to capital, liquidity, and so forth. And that makes, I think, a big difference as we go forward in an economy that appears, based on the charts, it looks like Wall Street's expecting the economy to grow. So if you're getting more access to capital and liquidity among those small and mid cap companies in a market environment that's growing, and now you're starting to get a little bit more of an advantage, you can see that the market winds shift a little bit. And I believe that's what we're seeing in the market right now. It's what we've been calling for really since the beginning of 2024 at Market Vision 2024. That was back in January. What I said was when rates started coming down, and I thought they would in 2024, I thought they would have earlier this year, but that was delayed a little bit. But when rates start coming down, I talked about the financials, I talked about the industrials, and I talked about small caps, mid caps benefiting from that. And that's exactly what we've seen here over the last couple of months. So I think that scenario continues. How long? Well, it's tough to say. I mean, I think as long as the Fed is in cutting mode or the market's expecting rate cuts, I think you're going to see this rotation continue. When we do break into the new year, history changes a little bit. We start to see a little bit more strength in some of the larger cap names. For instance, the internet stocks love the month of January. Would absolutely keep that on your radar. As we get closer and closer, you start to see some of those internet companies break out. And I think that would be a really bullish signal. One already has in Netflix. Netflix has been going crazy. It did pull back yesterday, but with January ahead of it, that's its best month of the year by far. Netflix, if we get a pullback in December, that's one I certainly would keep on my radar heading into its earnings month of January. But anyway, small caps, you can see definitely outperformed yesterday. The S&P 600 small cap index up 1.8%. S&P 400 mid cap up 1.45, easily surpassing the Dow's 1% gain, especially the S&P and NASDAQ, which gained much lesser percentages. So overall, pretty good action, I thought, yesterday. Although, again, a little bit of selling late in the day maybe took away some of the, I don't know, maybe some of the shine off the market advance. All right, moving on, 10-year Treasury yield. So 10-year Treasury yield, let's get an update here. I talked about, I think it was in the weekend recap that I did. I know I did it recently in a video, and I'm pretty sure it was Saturdays. But anyway, when I was looking at the TNX, as you can see, the last couple of months, it's been coming up pretty strongly. But look at the PPO rolling over. So as the yield moves up, that means prices are going down. Folks are fleeing bonds. They're getting out of bonds. That's what sends the yield higher. And what they're doing is they're turning in and getting into the stock market. Now, if this starts to roll back over, it means folks are getting into bonds a little bit, and that could maybe slow down the advance in the stock market. Remember, there's always new money coming in. So the stock market and the bond market are not totally about rotation. You also have to realize there's lots of money that continues to pour in to both. But the rotation can really add to a rally in stocks or bonds. So that's what we kind of watch for there. But as we were going up in the yield, you can see that negative divergence. And as a result, I said, wouldn't be surprised if we moved back down to 4.1, 4.2%. And almost like clockwork Monday, we pulled back quite a bit, I think down about 15 basis points. Today, we've moved up about 3. We'll see how we continue throughout the day. My guess is that we either work our way down to 410 to 420, or we sideways consolidate and just allow this 50-day moving average to come up underneath. That's what I would be looking for. I'd be surprised if we just see a complete reversal and a breakout again, at least in the short term. Not ruling that out for the longer term. If the market believes the economy is going to strengthen, more and more folks will get out of bonds and get into stocks. And so as they get out of bonds, that is going to send the yield up a little bit, or at least keep it fairly, maybe status quo. So for those looking maybe for a major drop, and I talked about this a few months ago, that I thought things were shifting in the bond market because the bond market for a long time was reacting to inflation news, and then it started changing. And in my opinion, this last move to the upside has absolutely zero to do with inflation and has everything to do with what the market believes we're going to get down the road now that rates are being cut. Short-term rates are going to be cut. I think the market is expecting that the economy is going to pick up. And as a result, folks are getting out of bonds and getting into stocks. That's the way the relationship works. Moving on to the Dow Jones. So I just wanted to show, here was a breakout. We have a slight negative divergence on the Dow, but we just made the breakout. We don't know where this rally takes us. We could certainly just keep moving up, and that PPO move to a new high. So I think that's a definite possibility. And I maybe not even a possibility. I think that's what's going to happen here with the Dow. I mean, we came off the center line, which was perfect. We had what looked like maybe a slight negative divergence back in October, went down. This is what I call reset. We get back down the PPO to the 0 line. That means your two moving averages, your two exponential moving averages are exactly the same. 20 days not above the 50, 20 days not below the 50. We're at exactly the same level. There's no momentum. Short-term moving average equals the long-term moving average. That's the definition of no momentum. Zero momentum, which is why it's the 0 line. But anyway, we get down there. We have a 50-day moving average test. We have a 0 line test on the PPO. And at that point, to me, the market is free to go wherever the PPO means nothing to me at that point. It's not bullish. It's not bearish. We just got to see where we go from there. Well, we found out where we went. We went right back up again. So now when we start up, when we made this breakout right here in early November, you could have pointed to this and said negative divergence by definition, right? You break out, you have a price high that's higher than the price high before, and you have a PPO that's way below where it was before. by definition, that's a negative divergence. Well, I mean, I could go back and show you a long-term chart on the NASDAQ. We've been in a negative divergence ever since we've broken out above the 2000 high. And we just stay there. Why? Because back then, 1999, we had an unprecedented rally that sent the PPO to levels that we've never seen before and probably never will again. And so every time we break out, if you compare the breakout level of the PPO to 1999 or to 2000, we always have a negative divergence. I don't know if that might be on the weekly and the monthly charts. But anyway, my point is here is that once you go back down to the zero line, forget about all these prior highs. Just like on the NASDAQ, we've gone through bear markets. I mean, the PPO went negative. Who's still looking at the PPO from back in 2000 and comparing it to come up with a negative divergence? Nobody. Well, at some point, there's a time frame that you have to start ignoring that. I think as soon as you go back down to the center line, you should ignore it, because there, the momentum's gone. Whatever negative divergence or negative or slowing momentum that was out there is gone when you get back to the zero line. So anyway, here I see the market going up. I see bullish momentum accelerating off the center line. Again, I'm forgetting about all this October, September, August stuff. I'm not looking at any of these. I'm not looking at this as a negative divergence right here. We go up, we come back down. Where do we stop? 20-day moving average. When you have a strong PPO, pullbacks, I like to see hold that 20-day moving average. We did that perfectly. And then right back up to a new high. I believe we're going to break out on this PPO in the next couple of days and have a new high. I'm not personally worried at all about this negative divergence. S&P 500, there's your failure again at 6,000. Slight negative divergence, although we haven't closed at a new high. So remember, it's not based on intraday highs. PPOs are based on closing prices, not intraday prices. So you have to look to see if you have a higher close in terms of price action, which we don't have yet. We could get one, but I see the S&P very similar to the Dow, getting down close to that center line. Right here, we got the 50-day test. We break back out. PPO is strengthening on this price high. We pull back, we hold the 20-day moving average, and here we come again. I wouldn't be surprised to see this breakout and the PPO go right back up and break out above 1. Now, does that mean we're going to do it today? I don't know. I mean, we could, have a pullback at any time. Market's been pretty strong. So you've got to expect pullbacks from time to time. NASDAQ 100, a little weaker. So you kind of see the Dow makes the breakout. The S&P 500, which is a little bit more aggressive than the Dow, got a lot more growth stocks represented in the S&P 500. And it's only getting to the recent high. It hasn't broken out. And then you look at the NASDAQ 100, which is a very aggressive index in terms of large cap growth stocks. And it hasn't gotten back to that recent high. You're looking at, NVIDIA. NVIDIA's struggling, got up near it, made a new high up in the upper 140s and it's pulled back into the 130s. You look at Microsoft, you look at Apple, you look at Meta, you look at Google. I mean, all these companies are pretty, well off their prior highs. And so money is just rotating. Those aren't bad companies. I mean, Apple, Microsoft, they're great long-term holds. But if that's the majority of your portfolio, you probably haven't been going much, haven't been doing much, and you're not at an all-time high in your portfolio. If, on the other hand, you switch to the small caps and you take a look at the IWM, a lot more strength recently. And this is that shooting star that I talked about. We did close above the open, though. To me, that's a better shooting star than the other, the flip side where you close below the open, because then you're right down all the way at the low of the day. This is a little bit better, but still, that's a long tail to the upside up to around 245. We did make a breakout to a new closing high yesterday. So that's a slight positive. Well, it's a positive, no doubt. But with that reversal, I mean, I wouldn't be surprised to see a little bit of selling, but I don't think this uptrend is over yet. We'll see. Maybe I'm wrong. Maybe it is. Maybe we're going to go back down, test 225 and get down the 50-day. I just don't think it's going to happen. I think there's too much momentum in the small caps right now. And I think the fact that we're turning back up here, it's only a matter of a couple of days probably when we get that breakout. But I do want to be objective. Do want to point out that is a potential reversing candle. You can see for 4 days in a row, we closed almost on the highs each day, certainly in the upper end of the trading range each day. Yesterday was a little different. We had the gap up. We broke out. We're clearly in all-time high territory. And then we saw some selling late in the day, or actually throughout much of the day. If we pull up the 10-minute 5-day chart, all the buying was basically done at 11 o'clock in the morning. And then we saw selling, which had another, we tried to rally again early afternoon and then went back down to the lowest point, or close to the lowest point that we'd had since 11 o'clock and toward the low of the day. So is this starting a downtrend? I don't know. I think first thing to watch is yesterday's low, because we've been putting in higher highs and higher lows every day. So yesterday's low was at 241.39. To me, that would be the first level I'd watch to the downside. If you lose that, you got next gap support, in my opinion, which is down at about 238 and change. So those are a couple levels. Keep an eye on the IWM. All right. Let's go in. I just wanted to mention at EarningsBeats, if you go over to EarningsBeats.com, I know many of you are already members. Thank you so much. We appreciate your support. That's what enables us to do this and continue doing a lot of the things that we do, trying to keep a lot of investors and traders informed, not just what the S&P 500 is doing, but a lot of those below the surface signals. I don't think every all-time high on the S&P 500 is created equal. I think that there are a lot of things you have to look at besides just what that S&P, the benchmark is doing. And we try to do that as best we can for all of our members. So again, we appreciate you. If you're new to EarningsBeats, or maybe you're new to this video, maybe you've never seen this before, a couple of things. We do have a paid service that's a 30-day trial. You can come in and start that trial at any time. You can see it right there, that green button. You do have to provide your credit card, but at the end of 30 days or right before the end of your 30 days, we will reach back out to you and let you know that you're going to expire. And if you don't cancel, then you're going to be hit with the regular monthly charge. And of course, we have an annual rate that's way cheaper than the monthly charge. So if you like our service, that's the way you definitely want to go. Anyhow, we also have a free newsletter, and this is what I want to concentrate on, because we have tens of thousands of folks that subscribe to our EarningsBeats Digest. It is, I'd like to think of it as being very educational. That's what I try to make it anyway. It comes out Monday and Wednesday. We're going to have a special one out this Friday, day after Thanksgiving. So we'll have 3 out this week. But it's just a chart and a couple of paragraphs talking about things that are important to us at EarningsBeats. So it could be a stock that gaps up with earnings. It could be a stock getting ready to report earnings. And we just analyze what we think they're going to do with earnings based on relative strength and how the stock's been trading relative to a lot of its peers and so forth. It could be a sentiment chart that we use to help guide us in terms of short-term market direction. There's a lot of different things that we talk about. But anyway, if you'd like to be part of that, no credit card. It's completely free. Simply you put in your name and your email address. I don't know why my name always comes up there. But anyway, name, email address, hit that subscribe button. You're good to go. Again, no credit card required. You can unsubscribe at any time. So check that out if you are new to EarningsBeats. I think that will really help you. And if you are on your mobile device, we'll put a slide up. You can definitely click on or scan the QR code. That'll take you to the landing page, or we'll have in our description a link to that landing page as well. So either way, you can find your way into, or you just go over to EarningsBeats.com on your computer or mobile device and just go to our homepage and sign up. But we have a huge crowd. It makes sense. It's free. And once you get used to us, it'll also give you an opportunity to see the types of things we do, and you'll see if we're a fit. So it's almost like a free, just a free test run of EarningsBeats and what we do. And that could give you the confidence to take on a 30-day free trial. I think right now is a great time to be involved on our trial, because we are reaching out to our members a lot with some excellent small cap stocks that have been exploding to the upside. So I would check it out now rather than later personally, but that's completely up to you. Again, there is a free alternative in the Earnings Beats Digest. So what I want to do next is I want to show you one of the stocks that I just gave out on I gave it out twice. Yesterday, I gave it out in the Earnings Beats Digest. It's RH. I'll show you down here, relative strength. But RH was a stock that we gave out last weekend. So last weekend, we had a free event talking about small and mid-cap stocks. And during that event, we said, hey, if you come over and give us a try, just a 30-day trial, we'll give you a video, a bonus video, where we're going to give you a chart that explains why I believe why I believe small caps and mid caps are going to outperform. The chart that makes me believe that. And then I said, I'll give you 10 small cap or mid cap stocks that I really like. RH was one of those 10. This was last weekend. This red candle down here where we finished at 315. Look at the 6 days since. From 315 to 390, actually intraday almost hitting 400 yesterday. That's how fast. And this wasn't the only one, by the way. This was one of 3 of the 10 that went up more than 10%. And I think it was at least 5 of them went up at least 5%. And I think 9 were up, 8 or 9 were up last week. Only 1 was down. Or maybe there might have been 2 down. I think 1 was down fractionally and then another one was down like 2 or 3%. But the overall performance of these 10 stocks was outstanding last week. Outstanding. Anyway, when you look at this stock, you can see the big move and look at the volume that came in back in September. Huge move up. It's been mostly consolidating since then. But look at this AD line just continuing to move up. And as soon as we started to make this move to break out, we go up to new highs. So we're seeing what appears to be strong accumulation. We've got great volume trends. When we get volume, we're seeing the market, or we're seeing the stock go up. If we come down here, look at the stock relative to the home improvement retail group. New 52-week high. So you're in a great space with the small caps because money is pouring into small caps. You just made a huge breakout relative to your industry group peers. You're showing signs of accumulation. You've made breakouts. I mean, I don't know what else is left for a stock like this, but there are lots of stocks that look like this that maybe haven't made those breakouts yet. And that's where we're going to be focusing a lot of our time and effort at Earnings Beats over the next several weeks, maybe a year. You know, sometimes when the small caps go, they go. And when they go like semiconductors. They rip to the upside. And that's what we're seeing, even like I said, looking at the IWM. This is an index of 2,000 stocks. Very, very widely diversified. Unlike the QQQ, where Microsoft and Apple, have a huge piece and chunk of the QQQ, there's no company that has a big chunk of the IWM. I'm not sure exactly what the most heavily weighted stock is, but I'm going to say it's probably like 1 or 1.5%. And then you go down quickly. I mean, if you got 2,000 stocks, obviously there's not going to be a whole lot of weighting in any one particular. And so anyway, I think the IWM as a group, the whole group is going. And so it's just a matter of, which one you want to get into and which one looks good and which ones are leading. And so that's what we're focusing on. A couple more charts. It's 9:29, so market's opening in a minute. Here's the IWM relative to the QQQ. I really wanted to show you what's going on here because what's happened over the course of the last 10 years, if you look at the IWM versus the QQQ, even maybe 15 years, what's happened is that we get these quick pops to the upside in relative strength of the IWM. That's what's happening here on this chart, by the way. IWM : QQQ. When you type that in at stock charts, it's basically saying IWM divided by QQQ. So it's giving you a ratio of how the IWM is versus the QQQ. Well, as you see this ratio go up, it means IWM's outperforming. When we go down, it means the QQQ is outperforming. IWM is underperforming. Well, normally what we've seen, let's go back. Let's see if I can go back here a ways. I'm going to go back 15 years. And you're going to see a lot of underperformance by small caps. I mean, look at this. But usually what we have are these pops, and then we go back into selling. And then we have this pop, and then we go back into selling. And then we have this pop, we go back into selling. We have a pop, we go back into selling. I think we're popping. Now, the question is, how far do we pop? Well, first of all, am I right about small caps? We'll see. I think recently, I think it's starting to point that way. And we're about to get some confirmation. If we can start to take out some of these relative tops that we've seen over the last year, I think that would be a really big confirmation of what we're already seeing. So that's what I'm going to be looking for. But look at these moves and how fast the small caps show this relative strength. Now, what you don't see, and what I'm going to do is I'm going to go back and show you the IWM versus the spider, which IWM versus the spider also looking very strong. Had this move up. Now, what we normally see is just after that, we go down to a new low. In this case, after we spiked up, right here, when we came back down, we didn't go to a new low. And now we're turning and starting to move back up again. This is completely different than what we've seen in the recent or even in the distant past. But the IWM, this is interesting because, everybody's, saying, small caps, they never make any money for you. They never outperform. If we go back to the turn of the century, and I'll move this to a weekly chart just so it's a little less, shows a little bit more of what's going on. But people forget that there's been a time right here. This was a decade. Actually, if you go all the way out here to 2013, 2014, it's like a dozen years of outperformance by the IWM over the S&P 500. So what everybody's used to, and a lot of folks have recency bias, what everybody's used to is this: small caps underperforming, getting absolutely torched. What if this is a start? I'm not saying it is. I think it's way too early to make that call. But what if this is the start of what we had starting in 2000 that went for 12 years, all the way to 2013? Maybe small caps are starting to maybe going to flex their muscle a little bit. I don't know. Again, I think it's way, way too early to make that call. But I do think we're going to see significant strength in small caps. I've said before, if we look at the IWM, right now we're at 240. I mean, it wasn't that long ago I said I thought we could go to 300. And I even made that call, said we could do that by the end of the year. Now, IWM got started a lot later than I thought in terms of breaking out. So it would be shocking to see it get to 300 by the end of the year. I mean, we're only talking 5 weeks away. That would be a 20%, almost 20, well, it'd be 25% move to the upside. So no, I probably wouldn't go there. But I think in the next year, not only do I think you get to 300, I think there's a chance it goes to 400. It's a pretty bold call. 67% in 13 months. I think there's a chance. So if you're wondering why I'm so bullish and why I talk about small caps all the time, it's because that's what I believe. I think that as long as the Fed keeps cutting rates, I think this is setting up for a surge in profit margins, multiples. Once you start turning the corner, you start showing growth, you see what we've been seeing for the last month or two. But if this continues, this is the start. This isn't the end. This is the start. So anyway, keep all that in mind. Earnings, I just want to mention a couple companies. SMTC, big, we'll just pull the chart up since the market's open. Big gap up this morning. Here's a stock, though, that had been doing pretty well. PPO remaining above the center line. AD line had remained, consistent, pretty much sideways while price action was sideways. We'll see how this finishes, but a really nice gap up today on strong results on SMTC. Zoom has kind of been all over the place. So when they came out, by the way, they beat on the top line, they beat on the bottom line, they raised guidance. I actually held Zoom into earnings. I don't hold too many stocks into earnings. I did on this one. I'm paying the price this morning, but I'm not selling the stock. I think the gap down and the move to the downside is an opportunity. At least to me it is. Could we go back down to 75, 77? Yes, we could. I'm treating this much more as a swing trade. I think this is a stock that could do very well over the next few months. And so I'm not really overly concerned. I mean, I would rather have the gap up. Don't get me wrong. But I do think on this chart, we're still in an uptrend. The gap down, I think, presents an opportunity. We'll see if we hold the 20-day. If not, that's when I think the 75 to 77 range could potentially come into play. Remember, on a long-term chart, I'm going to go back weekly, 5 years. We struggled at getting through $75 on this weekly chart for a year and a half, close to 2 years. So the fact that we got through, that now means 75 is good support on the long-term chart. So it's not just the daily chart I'm looking at. Wanted to make sure you're aware of that. So anyway, Zoom came out, they beat, but you can see the gap down, the stock down 5.5% so far today. There was another one, Agilent. This one was closer to the break-even point. Actually, it did gap down quite a bit. But notice, this is what I talk to members about in trading these earnings. I don't know if Agilent beat top and bottom line, but if they did, the fact that they gapped down just above this recent support level is usually a signal that we're not going to break down. And look at Agilent. It opened at 125.45 and went to 131.49, and we're only 6 minutes into the trading day. That's a pretty big move, 5% in 6 minutes from a stock gapping down above above support. That to me is normally a sign that we'll rally off of that. And in this case, we did. So that was good that we pulled that one up. I don't really like the AD line, though, on this stock. And probably relative strength isn't great. There's your AD line, just set a new 52-week low. And AD, or the relative strength versus medical equipment companies, not good. So to me, this is a day trade, not a swing trade, not a hold. And at this point, I wouldn't be day trading it. I mean, it's already moved up $5 from where we were. But, when you trade earnings and you see what's going on, if you've planned properly and you already know how these charts look and what, the strategy that you would take, whether it would be a get in on weakness for a longer term swing trade, or maybe a get in on weakness if it opens above a certain level, all of those things need to be thought about before the market opens, because obviously you have a split second at the beginning of the day to make a decision. Or you could wait, and see how the market plays out over the first 30 minutes or so. But I think there are opportunities right at the opening bell on this one. Of course, hindsight 2020, but that's the type of stock that I would get into at the opening bell if they beat top and bottom line with their earnings report. Anyhow, that's it for me. I appreciate you tuning in. Let's get a quick look on the overall market before we wrap this up. Dow down 175. NASDAQ actually showing some relative strength today. So we got a little bit of a move back into some names that have been weak of late. S&P down about 0.7%, or that's a small cap, by the way, 0.7%. Mid caps down almost 0.5%. VIX, though, down, even though we're seeing a little bit of weakness in some of the areas of the market. VIX down another 2.6%, back down to 1422. And as I have said, once you get down below 17 on the VIX, good things usually happen in the stock market. So with that, I'll wrap up. Listen, I want to wish everybody a happy Thanksgiving ahead. We won't be back to do this show again until next Tuesday, but have a happy Thanksgiving. Enjoy some time off with families and friends, and hopefully remain safe, obviously. And we'll see you back here next week. Happy Thanksgiving, everybody. Happy trading.